Hello and welcome to the Chapter 9 lecture, first part, on accounting for receivables. So we've gotten to look at the complete accounting cycle in detail. We saw it for a merchandising company, we looked at inventory in detail, and then in Chapter 8 we started to look at cash in greater detail. Well, now for the remainder of the course, we will continue to look at our assets in detail. So we move on to receivables. You remember from Chapter 2, Chapter 3, a receivable is when a customer promises to pay us later on after we have already provided the service or delivered the goods. Now we're going to get to see how we need to record for accounts receivable, some special topics as it applies to accounts receivable, and we'll also get to see some information on notes receivable as well. So if you take a look at these companies here, tons of companies have receivables where they allow their customers to pay them later on. Now there's typically some type of arrangement already in place so that you can go in, purchase what you need, or you can order what you need, and the company does not require payment for 30 days. There's no interest attached unless you pay beyond the 30-day point, then there is usually some type of interest charge. But for that 30-day period, you are allowed, as long as you pay within that 30 days, you don't have to worry about any interest. So tons of companies use receivables. They increase sales because customers feel like they have a different way to pay outside of cash or outside of a credit card. So lots of companies use receivables as an incentive to increase sales. Keep in mind that from the company standpoint, they do have to keep track through the use of that subsidiary ledger of each accounts receivable separately. So in this example here, we get to see journal entries for accounts receivable, the origination of an accounts receivable on July 1st here, and the collection of cash on an accounts receivable that will end up reducing an accounts receivable. So here we have TechCom had a credit sale of $950 to Comp Store and a collection of $720 from RDA Electronics from a prior credit sale. Accounts receivable, like all of my other assets, have normal debit balances. So we debit accounts receivable, we credit sales. For the second entry, we debit cash, but this time we're reducing accounts receivable because the customer is paying off a portion of their receivable. Now, in terms of the subsidiary ledgers, we're going to keep track of each customer separately so that we can send them statements, so that they can have an idea of how much they owe us, and so that we can keep track of who owes us what. We will then do an accounts receivable a schedule of accounts receivable that lists all of my subsidiary ledgers, each customer along with their account balance, and that should add up to the total amount in accounts receivable. Now, what about credit cards? Because we haven't talked about credit cards. Same as accounts receivable, in that companies allow their customers to pay with a credit card. How we record the credit card does depend on the arrangement that we have with the credit card company, whether or not the money will be immediately deposited into our account or whether or not we'll have to send receipts in and then wait for a couple of days to have the money transferred into our account. So let's see this example here. On November 1st, TechCom recorded sales on their own credit card in the amount of $1,000. So this is with a store credit card. On December 31st, TechCom recorded an adjusting entry for the interest earned at a rate of 1.5% per month on the seller credit card. So TechCom in this example has issued its own credit card to its customers, and those customers have charged $1,000, or it could be just one customer. So we debit accounts receivable and we credit sales. On December 31st, the customer has not paid the balance, so now the customer owes us some additional interest. So in this case, we debit accounts receivable and we credit interest revenue. Now, if it is a bank card, then that is a completely different situation. If it is a bank card and the bank deposits the money into our account immediately, then in that situation, the journal entry is different. So what do I mean by a bank card? A Visa or a MasterCard, not a store card. So not a card from TechCom itself, or not a card from JCPenney's, but a card that is issued by a bank, a MasterCard or a Visa. So on July 15th, TechCom has $100 of credit card sales with a 4% fee. And it's $96 cash is received immediately on deposit. So when the transaction is processed, there's already an agreement with MasterCard or Visa, and they have now deposited the money into our account once that credit card, not too long after that credit card is swiped. But the money that is deposited into our account is not the full amount. There is a percentage that is taken by the credit card company. This is why sometimes you go into smaller stores and they'll tell you you need to have at least $10 in purchases in order to be able to use your credit card. You don't see that as much now. It used to be a few years ago you'd see that more. But that was because of that fee that the credit card companies apply. So in this case, we debit cash for the amount of cash received. We debit credit card expense for that 4% fee. And we still credit sales for the full amount, but we need to take into account that we don't get all of the cash. Now, in some situations, we will allow our customers to pay us over time. And this is a sale on installment. So each month or each period, they're making a payment over an extended period of time. We see this a lot with companies that sell, sometimes you see it with furniture stores. Sometimes you will see it with companies that sell equipment, big ticket items like the John Deere pieces of equipment, or Caterpillar, because a lot of times with those pieces of equipment, it just costs too much money for someone to pay outright for it. So they are allowed to pay over time. When you have a sales on installment, that is where there is a periodic interest amount as well. So the customer is usually charged interest, very different from just a regular old accounts receivable. Now, when you have accounts receivable, when you allow your customer to pay you later on, it is inevitable that some customers are not going to be able to pay for whatever reason. And when a customer can't pay you, that's referred to as bad debt. So there are two overall methods that we can use to deal with bad debt. There is the direct write-off method, where as soon as it comes to our attention that we are not going to be able to collect on the debt, we write off that account, which means we eliminate that customer's accounts receivable and we record an expense. With the allowance method, we don't wait until we determine that we can't collect on a customer's account. We estimate our bad debt and we record that estimate in the same period as the sale. And then later on, and we record it, but in estimating it, we're setting aside a pot of money. And later on, when we determine that the customer can't pay us, then we take or we write off the customer's account using that pot of money. We'll talk about the allowance method more in a bit. Let's look at the direct write-off method. So for this one, TechCom determines on January 23rd that it cannot collect $520 owed to by its customer, J. Kent. Under the direct write-off method, we debit bad debt expense and we credit accounts receivable. We take that customer's accounts receivable off the books and we show that, oh, we're not going to be able to collect on that debt. So that's a loss. Yes, we originally recorded it as a sale, but now we can't collect on that sale. So it's some type of loss to us. It is going to reduce our profits. Now, what if we've written off the customer's account? Now, usually we'll write off the customer's account. We don't send them a note that says we've written off your account. We just do it so that we're not wasting money trying to collect on something that we don't believe we're going to be able to collect on. But what if the customer is able to make good on the payment and they send us money? Do we send them the money back and say, oh, no, we already wrote off your account? Absolutely not. We take the money. But before we can record the money coming in, we need to reopen the customer's account for the amount that they send to us. So after we've written off J. Kent's account on March 11th, J. Kent sends us money. We're going to reverse the entry that we did previously. So remember here on January 23rd, we debited bad debt expense and we credited accounts receivable. Here, we're going to reverse it, and we're going to reopen that customer's accounts receivable and credit bad debt expense. As soon as we reopen or reinstate that account, we immediately take it off the books again by showing the cash coming in. So now we can debit cash and credit accounts receivable. If we don't take this step here, it's going to make it look like the customer paid us when they didn't owe us anything. So it's going to make it look like we actually owe that customer a refund. So it's very important that you remember to reinstate the account after it has been written off if a customer pays you later on. Now, in dealing with the direct write-off method, it violates the matching principle. It works well if you don't have a lot of bad debt or if the bad debt is immaterial. And when I say materiality, I mean, does this number have a significant impact on the financial statements? Will it change a user's decision one way or another? Everybody has a materiality threshold. What is it going to take for you to make a decision on something? If you're walking down the street and you see $1 on the ground, if you'll stop and you'll pick up the dollar, then your materiality threshold is $1. If that's enough money to impact your decision. Now, if it's a penny, you may not stop to pick it up. It's below your materiality threshold or it is immaterial. So if bad debt is immaterial, it's a small amount, you can use the direct write-off method. But GAAP does not like the direct write-off method because, again, it violates the matching principle, also known as the expense recognition principle. And that is because you may make a sale in 2019 and you may not discover that it's uncollectible until 2021. You'll record the sale in 2019, you'll record the bad debt expense in 2021. You have revenues in 2019, expenses in 2021. So we're violating that matching principle. So we can only use the direct write-off method if bad debt is small or immaterial. So what method are we supposed to use? The allowance method. Under the allowance method, we estimate bad debt using a percentage. In using this method, we end up not violating the matching principle because we record bad debt in the same period as the sales. And it also allows us to show our accounts receivable at the amount that we can reasonably expect to collect, or its net realizable value. Let me show you what I mean. So the allowance method requires that we do an additional adjusting entry, and that adjusting entry covers bad debt. So TechCom has credit sales of $300,000 during its first year of operation. At the end of the year, $20,000 of credit sales remains uncollected. In other words, this is accounts receivable. Based on the experience of similar businesses, TechCom estimates that $1,500 of its accounts receivable will be uncollectible. So what we have to do is record an adjusting entry for this $1,500. We debit bad debt expense for the $1,500, and we credit our new account called allowance for doubtful accounts. Allowance for doubtful accounts is a contra asset account. And we've seen a couple of contra asset accounts. We saw one with accumulated depreciation. We saw one for the allowance for sales returns and allowances in the appendix to chapter 5. If you skip the appendix to chapter 5, don't worry about that. The point is that this account is linked with accounts receivable, but it has the opposite normal balance. It allows me to show accounts receivable at the amount that I can reasonably expect to collect. So on the balance sheet, accounts receivable is shown net of the allowance for doubtful accounts. This account is not only a contra account, it is also referred to as a valuation account because it helps me make sure I can show something else at its proper value. So a user of the financial statements needs to know that although this company has $20,000 in accounts receivable, they're only going to collect $18,500, or they only expect to collect $18,500. This is why it is important that we estimate our bad debt. Now, the estimating of the bad debt is a different process from the actual write-off. because yes, we estimate for bad debt, but it still comes to our attention that a customer can't pay. We can't leave their accounts receivable on the books sitting there forever. We have to at some point write it off. It's just that now when we write off the customer's account, we don't debit bad debt expense. You only debit bad debt expense in the adjusting entry when estimating, like we did back here. When we're actually writing off the account, we need to debit allowance for doubtful accounts. This is the pot of money that we've set aside to deal with bad debt. So we debit allowance for doubtful accounts and we credit accounts receivable to take that customer's receivable off the books. So notice that before the write-off and after the write-off, the value of accounts receivable is still the same. And that's because I'm using my valuation account. So this contra account, I like to abbreviate it as AFDA because it's a really long account. So this valuation account helps me show my accounts receivable at the amount that I can reasonably expect to collect. So when I write off an account, I'm still showing my receivables at the net realizable value. Now this works the same way when a customer pays me later on because they don't want to take the hit to their credit report. So even though I wrote off the account, they may still want to pay it. And in that situation, I reverse the entry that I did before when I wrote off the account. So I debit accounts receivable and credit the allowance account. And then I debit cash and credit the receivable to take the accounts receivable right back off the books. Now, let's look at the different ways that we can estimate bad debt because there are a couple of ways that we can do it. We can use a percentage of sales or we can use a percentage of accounts receivable. Under the accounts receivable method, there are actually two specific methods we can use. I can just take my full accounts receivable and find a percentage for that and use that as my estimate. Or I can separate out my accounts receivable based on how long they've been outstanding and then assign a percentage to each group of accounts receivable based on how long it's been outstanding and then calculate my bad debt that way. So let's look at the percentage of sales method. With this, I am given my current period sales. Typically, it's credit sales. Sometimes it can be total sales, but most of the time it's credit sales. So I'm going to use my credit sales and I'm going to multiply that times a given bad debt percentage. This is based on past experience of the company. If we're talking about it from the classroom standpoint, the bad debt percentage will be given to you. You're going to multiply that times the current period sales, and then that's going to give you your estimated bad debt expense. This is the number for your entry. So let's see this one. Musicland has credit sales of $400,000 in 2017, and it is estimated that 0.6% of credit sales will eventually prove uncollectible. I multiply that 400,000 times 0.6% to find my bad debt expense. I debit bad debt expense and I credit the allowance for doubtful accounts. For the percentage of receivables method, there is a little more work because once I multiply my percentage times my accounts receivable, the number that I get is not bad debt expense. It ends up being my desired ending balance for AFDA. In other words, that's what I want AFDA to be. I have to subtract that number from the previous balance in that allowance account to find my bad debt expense. This is one of those ones that works better with numbers. So let me show you some numbers. So still dealing with Musicland. This time Musicland has $50,000 in accounts receivable and some money already sitting in the allowance for doubtful accounts. So there's a balance here of $200. That's what I'm looking for. Now, to find my bad debt, I need to find the number for my entry here. The number for my entry is calculated by taking my accounts receivable and multiplying it times my percentage of uncollectability, or my bad debt percentage here. And that gives me $2,500. This $2,500 is what I would like my allowance for doubtful accounts to be at the end of the period. It's not right now. Right now it's $200. So I take the difference between where it is right now, the $200 credit balance, and where I would like it to be, the 50,000 times the 5%, and then that is the number for my entry. That is, in essence, my bad debt. So we debit bad debt expense and we credit AFDA for the $2,300 to ensure that I reach that $2,500 balance. The percentage of receivables method is said to have a balance sheet focus because the number that I calculate is ultimately the number that shows up on my balance sheet here. The percentage of sales method is said to have an income statement focus because the number that I calculate is the number that will show up on my income statement, or this $2,400 that shows up in bad debt expense. We can take the percentage of receivables method a step further by aging our receivables. This is when we break out all of our receivables based on how long they have been outstanding. Each group has its own percentage of uncollectability. The longer the debt has been outstanding, the higher the percentage of uncollectability. Then we're going to multiply for each group and then add all together to find our desired ending balance of AFDA. So if you're doing a problem like this in class, this information is given to you. They're going to tell you the balances of all of these groups based on how long they've been outstanding, and you will be told the percentage of uncollectability. In the real world, you're keeping track of what customer owes you and how long their debt has been outstanding, so you will be able to find or produce an aging of accounts receivable schedule. Now, once you find the total receivables for each group, you're going to multiply it times the percentage of bad debt, and then you will add all of your numbers together. This 2270, again, is not the number for my journal entry. This is the desired ending balance of AFDA. If there is already money sitting in AFDA, then I may have to subtract to find the correct amount for my entry, like we had to here. Now, what if we change, let me go back because I went too fast, like we had to here. This is what I want you to focus on. Now, in the recent problem, the balance of AFDA was 200 on the credit side. What if it was on the debit side? And this is possible. It just means that I wrote off more accounts than what I estimated for. In that situation, I would need to add my desired ending balance of AFDA to my beginning debit balance, because I'm trying to figure out how I get from a $500 debit balance to a 2270 credit balance. So I need to add those two numbers, and then that is the number for my entry. So in looking at my methods of estimating bad debt, all of this applies to the allowance method. Direct write-off method is easy. As soon as I know I need to write it off, I just go ahead and write it off. For the allowance method, I have to estimate bad debt. So I have to determine which estimation method I'm using, whether it's a percentage of sales that has an income statement focus, so it's focused on matching, or whether it's a percentage of receivables or an aging of receivables that has a balance sheet focus, where I'm focused on the ending balance of AFDA or the net realizable value. Now, that takes care of the first half of Chapter 9. Take a look at the walkthrough video where I do a couple of problems with you so that we can examine these different estimation methods. I so appreciate your time and attention, and I hope you have a wonderful day.